Want to be sure you are getting the most out of your retirement? For all the years of your retirement? That's the primary goal of More Living with Jim Brogan and our Dollars and Cents segment, where we provide you with an important financial tip that will help positively impact the quality of your life in retirement. And now, here's Jim with this week's Dollars and Cents tip.
How healthy is the stock market? You know, here in the last little bit, we saw the Dow click over 50,000. President Trump came out and said that by the end of his term, it'll click over 100,000. I don't know that I see that, but you know, that's what he says. But, you know, I get asked a lot of times, you know, God, how can it keep going up, blah, blah, blah. And it's been choppy the last week or two, certainly. But I want to use the S&P 500 and talk about that index and what we can learn from it and what we have to be careful about. You know, the S&P 500 is an index made up of 500 of the largest U.S. stocks. But that can be a little bit misleading in a couple of ways. One, every company does not have an equal impact on the movement of that index. It's not 1/500th each. In other words, the larger the company is, the more it impacts the movement of that index. It's what's called a weighted average index. And so what's happened over the last 5 or 6 years is the Magnificent Seven that you hear talked about so much. You know, that's the big, you know, NVIDIA, Google, Microsoft, Apple, those big technology companies. They have gotten so massively big that they're driving most of the movement of the index. Believe it or not, the top 10 companies in the S&P 500, the largest 10, drive 40% of the index. And we have had times in the last 2 or 3 years where the S&P 500 was up a good bit. But if you called out the 7 companies that make out the Mag 7, all the other 493 stocks were just kind of clicking along with hadn't really made any money in terms of the stock appreciation. More like a zero return, where the Mag 7 was having such a great run that it was showing a very nice return in the S&P 500. So first, you have to be, there was an article in New York Times last weekend that said, how safe is the S&P 500? And what it postured is it's not as safe and diversified as it used to be because you've got these big companies driving it. We have to also understand that the S&P 500, I say the largest 500 companies, about half those stocks are mid-cap stocks. So it's really, with that weighted benefit, it's very top-heavy. And so when we look at where we are today, it's interesting because now we're seeing things shift a little bit. We're seeing the earnings and the projections for the Mag 7 stocks start to recede a little bit, and we're starting to see more optimism among the other 493 stocks. Now, what does that mean for 2026? Who knows? I mean, markets are choppy. They're unpredictable. In a typical year, we see a market correction of 10 to 15%. That's just average. And that's, you know, a typical correction is healthy for markets. The key here is, over time, in our next 10 or 15 years, you need to be growing investments above and beyond the rate of inflation. And I think that's going to be critically important. We're seeing very good economic growth. They're predicting GDP growth this year, 5.7%. Risk assets over time provide the best opportunity to beat inflation. However, in the short term, they're completely unpredictable. So it's just critically important to realize when we invest, are you an investor or speculator? If your investments, you're worried about what they do the next 6 months, that's not investing, that's speculating. We just don't know. So there's a huge difference. That means it doesn't mean you can't speculate on just a small piece of your money. But as investors, we have got to understand that the more diverse and equity-based our investment plan is, the more we need time on our side. And so we shouldn't be thinking about where we're going to be in 3 or 4 months. That means we need safe and stability in our assets that provide short-term access to money and income. So just be careful with S&P 500 and what we can learn from that, and be sure that you have the true, proper diversification where you're not too overhedged in one sector of the industry.
That's our Dollars and Cents segment for this week. You can find this week's Dollars and Cents segment and others by visiting BroganFinancial.com.